My name is Greg Igleharte, and today I'll go over stock analysis for Finance 451. I analyzed two industries, the airline industry and the oil industry. I'm going to start with the airline industry first. I went over Southwest Airlines, American Airlines, Delta Airlines, United Continental, and JetBlue. I'm starting with Southwest. Short-term solvency, the current ratio is low and is progressively going down over the 5 years from 1.29 2010 to 0.54 in 2015. The cash ratio is average when compared to similar companies in the industry, but has gone down significantly since 2010 from 1.07 to 0.41. So long-term solvency, equity multiplier is below average for the airline industry, so it has a little less debt than some of the other companies I analyzed. The total debt ratio is high, but it can afford the debt because it has a very high cash ratio of 57%. The asset management is 0.97, which is high for the airline industry because they don't turn over a lot of assets. The return on assets has progressively increased over the past 5 years from 3% to nearly 11%. So management's doing a better job returning equity on assets. Management is not turning over assets often, which is common for the industry, like I previously said, and has a high return on assets of 11%. The profitability margin increased from 4% to 12.7% over the past 3 years, but that's average with the industry. The RA and the ROE is almost doubled since last year because of the increase in the profit margin, so they're turning more and they have higher margins. The return on asset is average, but the return on equity is actually low for the industry, even though they doubled it since last year. The market value has high price to earning ratio, which means future expected earnings are high, and the economic value added indicates that the company is growing. Second company is American Airlines. The current ratio is at 0.73. Again, it's below 1 like most of the airlines. Well, all the airlines I analyzed. Quick and cash ratios are similar to the other ones, so it really wasn't much significance to it. The long-term solvency actually didn't have much data on it when I pulled it from Bloomberg, but the cash coverage I noticed was relatively low compared to other industries, so I'm actually skeptical about their ability to pay long-term debt without more information. The asset management, like I said, below 1, average for the airline industry. Profitability had several years. American Airlines actually had several years of negative profit margin, but in recent years have turned it around. The return on assets followed the same trend of getting progressively better. There was insufficient information about the return on equity, and the higher profit margin responsible for the increase on the returns. The market value is average when compared to the others, and its price to earnings is relatively low. As you can see, the EVA is 17, so the company is growing. Delta Airlines has a average current ratio. The quick and cash ratio are actually low compared to the other companies, so I actually doubt the company's ability to pay short-term loans because of this. The equity multiplier is average. Debt ratio is low and the cash coverage is high, so that means they don't have a lot of debt. They have enough coverage cash coverage to afford the debt that they do have. The total asset management is average with other airlines I've analyzed. Profit margin has significantly increased over the last year from 2.1 to actually 11.36%. The increase in profit margin in turn increased the return on asset and return on equity, so significant improvement on all the profitability measures. The market value, the price of earnings is above average, so investors are projecting the company to do better than it was previously. Market and book are very similar to other airlines in the industry. And the EVA shows that, again, the company is growing just at a lower rate than others airlines I've seen. United Continental, current ratio is on par with others in the industry. Cash and quick ratios are similar, so really no significance to their short-term solvency. It's pretty much average. The long-term, it actually has a higher debt to equity, indicated that the company has a large amount of debt. The debt to equity ratio is high, although the company has below average total debt, and high cash coverage ratio shows that it can afford the debt that it does have. The asset management is below 1, but higher than other ones because this one actually is 0.98, and the other airlines that I've seen were 0.75 was the average, so it's actually a little higher. The profit margin is high and it's increased significantly in the last year from 3% to almost 21%. The increase in the profit margin allowed for large increases on the returns on assets and equity, and the return on assets and the return on equity are both high for the industry. Market value has a very low price to earnings. It could mean that the price is undervalued. The 13.72 economic value added shows that the company is growing like all the airlines that I analyzed. JetBlue is current cash ratios are similar to the other ones that I've seen. Nothing really significant here. Has the ability to pay short-term debt. The long-term solvency has a low equity multiplier, so it means it doesn't have a lot of debt. With a low total debt and debt-to-equity ratio as well. It has an above-average cash coverage ratio. It indicates that it can afford the debt, and it actually could probably take on more debt if it found it necessary to. Asset management is similar to the others in the airline. The profit margin is average, and the return on asset and return on equity are lower than average because the company carries less debt than other companies I analyze, so it on average has less debt than the other airlines. With the less leverage, the company is returning less on its assets and equity. Similar companies with more debt because leverage magnifies the gains and losses, and all the airlines are currently making money because oil is cheap. Price to earnings is average. Market to book is slightly below average. The company may be slightly overvalued and has 17% EVA, which means the company is growing. An overview of the airline companies. Airline companies across the board showed significant improvement due to a decrease in the price of fuel, as it is the airline's second highest expense. Experts believe that profit will decrease because of the lower price of airline tickets, but I believe the airlines will continue to do well as travelers opt to fly instead of driving due to more consumer-friendly ticket prices. The best choice, in my opinion, is going to be Southwest Airlines because it has shown the ability to turn a profit regardless of the price of oil or fuel over the last 5 years. There's also lower than average debt and high cash coverage to pay its debts. And although the price of earnings is higher than average, I believe that Southwest is a good long-term investment. The oil industry companies that I've looked over is going to be Chevron, ExxonMobil, Occidental Petroleum, Shell, and Valero. Chevron's company we're going to start off with. It has an average current ratio when compared to other companies that I analyze, as well as Quicken cash ratios are consistent. There's large differentiation between the quick ratio and the cash ratio, so it pretty much means that oil companies are carrying a lot of inventory, and that's pretty much the trend that I've seen with most of the oil companies that I analyzed. Long-term equity multiplier is slightly below average. The total debt ratio and debt-to-equity ratio are also below average. The company carries less debt than others in the industries, but I have insufficient information of the cash coverage, so I'm not really sure of its abilities to pay its long-term bills. Asset management has dropped over the last 5 years significantly, as I've seen with most oil companies, due to the lower price of crude oil. The oil company's been taking a pretty significant hit. Total asset turnover, like I said, dropped since last year, significantly since last year. The profit margin has actually turned negative in the past year, but it shows like a drop from 7 to 6 to -2. So they're actually returning negative profit margins, although they still had a positive return on asset and return on equity, significantly lower than last year. And market value, the price to earnings is average, the market to book is slightly below average, and with all the oil companies analyzed, the EVA was negative, so these companies are actually getting smaller. ExxonMobil, short-term solvency for ExxonMobil, the current ratio is relatively low, cash and quick ratio are low as well. It does not show the ability to pay short-term debt in my opinion. Long-term solvency has an average equity multiplier, so it's carrying an average amount of debt for an oil company, but it doesn't have, it's slightly below average for an oil company, so it doesn't have as much debt as others, but it still does have a pretty significant amount of debt. It does have high cash coverage, so it shows the ability to pay off the debt that it does have. Asset management, like I said, with most oil companies, has shown significant declines over the past 5 years, and in the past year, extremely large drop. The profit margin, return on equity, return on assets have all decreased due to the decrease in asset turnover. So these oil companies are turning over less assets, and because of that, their returns are suffering. Although the decreases in their profit margin, ROA and ROE, were much less drastic than the others I've analyzed. Market value is below average, and the market to book value is average compared to the others I've seen. As you can see, this one only shrunk 4%, whereas the other one was 16%, so it actually shrunk a lot less than other oil companies. Occidental Petroleum has an average current ratio, cash ratio, so that it does have the ability to pay short-term debt, and it's holding a pretty large amount of inventory, as it's shown it's done over the past 5 years. Long-term solvency has an average equity multiplier as well as an average total debt ratio, so they are carrying debt. It's normal for an oil company to carry the amount of debt that they do have. And it actually has a negative cash coverage ratio, so I do not believe that it has enough cash to afford the debt that it currently has. Its asset management has always been relatively low, but it's gotten even lower over the past year, so I doubt the management's ability to turn over assets efficiently. It has a negative profit margin as well as return on assets and return on equity, which is huge red flags that the company is struggling to turn a profit with the new lower price of oil. Market value is extremely high. The price to earning ratio is extremely high, and it has an average market to book ratio. Indicates the price of the stock may be inflated because of it is showing negative returns and overvalued based on recent performance. The EVA is negative 35%, well, almost negative 35%. It shows that the company has downsized significantly over the past year, and it was actually the second largest drop that I've seen. Shell, short-term solvency, current ratios, average, quick and cash ratios, so the company is carrying less inventory, so they have a little less inventory than other oil companies I analyzed. The equity multiplier is average, the total debt ratio and debt to equity ratio are slightly above average, so it's carrying maybe a little more debt than other companies that I analyzed, but the cash coverage ratio shows that it does have the ability to pay off this debt. Asset management is average compared to other oil industries, although like most I've looked at, taken significant drop in the past year. Profit margin is negative, although they're still returning positive return on assets and return on equity. I think the decrease is due to the decrease in total asset turnovers. Market value, the price of earnings is high and the market to book is low when compared to the others in the industry. The company has shrunk less than others I analyzed. I believe the stock could possibly be overvalued. And then Valero, it's the last company. The short-term solvency ratios show that it has a high current ratio and the quick and cash ratio are both high. Company is holding a large amount of inventory and it has the ability to pay short-term debt. The equity multiplier is average, and the total debt and debt to equity ratio show that it's carrying a normal amount of debt for an oil company. It also has a cash coverage ratio high enough to afford the debt that it does have. Its asset management is actually significantly higher than all the other ones I analyzed because it actually shows 1.9%. It's above 1, and all the other ones were averaging around 0.75. It shows that the management does have the ability to turn over assets at the reduced oil price. Its profitability has increased its profit while other companies decreased. So this is actually the only company I looked at that increased its profit margin, ROA and ROE from 2014 to 2015. And I believe that because it has such a high asset turnover compared to the other companies, it has the ability to do this. The market value shows that its price to earnings is low and its market to book value is average. So I believe that this stock could actually be undervalued. And the EVA shows that it has shrunk significantly. I believe that it shrunk significantly while still managing to turn a profit is a good sign. An overview, oil companies struggled in recent years with the decrease in the price of oil and on average decreased return on equity and return on assets. Experts believe that the crude oil price has yet to find its floor and that it may trend back down to $40 a barrel. So there's a lot of question marks surrounding oil right now. I believe Valero is my choice for oil stock. It has shown the ability to turn a profit while other oil companies are showing negative returns. It downsized significantly due to the decrease in oil price, but it still managed to turn over assets at a high rate, and the price earnings indicate that the stock could be undervalued. In conclusion, I noticed somewhat of an inverse between the airline industry and the oil industry. When the price of crude oil is high, oil companies do well and airlines struggle because of the higher fuel costs. When the price of oil is low, oil companies struggle to turn a profit and airlines flourish. The decrease in oil prices over recent years and the uncertainty of what the price is going to do, I would pick Southwest Airlines stock because of its ability to turn a profit regardless of fuel price over the last 5 years out of all the stocks I analyzed. Thank you.